Welcome back to another edition of This Week in 3 Minutes. I've called this one Data Sets and Crashes. Well, the last couple of weeks have been extremely volatile, both on the equity side and on the gold side. Gold softened quite a bit late last week and has now rebounded back to that $1,300 range. And of course, now we're watching the equity markets really start to roll over. As I predicted, it took a little longer than I thought, but we can see now the trend is not our friend when it comes to the equity markets. But rather than get too much into the details, I want to paint a broader picture and use an example. In World War II, the U.S. military wanted to figure out what was the best way to protect the planes from being shot down, and where were the planes being hit most by the enemy fire. And so they literally cataloged every plane that had bullet holes in it and tracked where those hits were. But one clever statistician in the U.S. military pointed out the obvious fact that they were only looking at the planes that made it home, which I thought was a perfect metaphor for what's going on in the markets today. With quants and central banks and other people trying to figure out, where to best armor the plane by looking at the planes that actually made it home. And unfortunately, I really think most of them are looking in the wrong spot. Some of the smarter people at the central banks might be actually on target with behavioral economics, which is it's a term that's perplexed me for a little while. But essentially, the best way I can describe it is look at demographics, the largest groups of people, and what are their spending habits at that stage in their life, which brings us to where we are today, which is, after a long 10-year of intense savings by a lot of people readying for retirement, they're about to retire. The peak is over the next 24 months or so, with the number of people retiring. I think it's something like 15,000 people retire every day in the United States right now, and it's going to increase over the next year or two. And of course, what happens when people enter into retirement? They become very, very defensive. Their spending habits change. The investments they hold change because they're extremely dependent on the nominal value or the cash value of their life savings to maintain that standard of life through retirement. And so obviously what's going to happen is there's going to be a mass exodus out of the stock market. Even if the market was flat or even going up, many of them would simply withdraw their funds and put that money into something that's safe and predictable. Now, predictable, of course, would be cash, so we may see a rally in currencies over the next year or two as people position themselves into safety. But alongside of that, a lot of people are going to really go to safe haven assets like gold. And so what I'm getting at here is that over the next year to two, I think we're going to see a tremendous move out of the equity markets into cash and cash equivalents like monetary gold. And with the lack of supply going forward, lack of exploration and discoveries, I think that the next 24 months or so for gold are going to be spectacular, and you will be well positioned to get through this coming crash. It's not a matter of if, it's a matter of when. And when I look at the markets today, and I look at the trend that began last fall, I think we're staring it right in the face. So I'm off next week, so I'll see you in 2 weeks. But in the meantime, have yourself a great weekend. Cheers for now.